As a trader, one of the most critical challenges you may face is identifying the best entry points. For many smart money traders, the main difficulty lies in deciding whether to use order blocks or fair value gaps as their point of entry. In this video, we will remove the confusion by outlining the specific market conditions where each method performs best. By understanding these key factors and applying the right criteria, you'll be able to refine your strategy and improve your chances of executing more profitable trades. So, if that's something you are interested in, kindly hit the like button. Also, subscribe and turn on the notification bell to stay informed each time we make new videos. So, without further ado, let's get started. As we all know, both order blocks and fair value gaps serve as common entry points for smart money traders. However, the challenge lies in determining which of these areas provides a higher probability setup and is more likely to be respected by price. For example, in this case, price reacted to the higher time frame order block, but ignored the lower time frame order block. This illustrates an important point. If your entries are consistently being missed, it's often a sign that you're over-refining your zones. Looking more closely at this example, we can see that the market was initially in a downtrend before reversing and pushing higher. And after taking out the previous high, it resulted in a change of character, signaling the start of a potential bullish trend. At this point, the goal is to find an entry for a long position. To do so, we first identify the discount zone, which contains both higher and lower timeframe order blocks. Now, if you were aiming to enter based on the higher timeframe order block, you could place a buy limit order at the top of the higher timeframe order block with your stop loss set below it. This approach would have tagged you into the trade as price would have triggered your order. However, it's important to understand that entering from the higher timeframe order block often results in a much larger stop loss, which reduces the reward-to-risk ratio and increases potential losses if the trade moves against you. To achieve tighter stop and a better reward-to-risk ratio, traders typically refine their entries to extreme lower timeframe order blocks. While this method appears attractive, offering a small stop loss and high risk-to-reward ratio, it is not always realistic, because price doesn't always respect lower timeframe order blocks. So, what exactly is the solution for this? In several cases, price may fail to respect order blocks, but respects the fair value gaps instead. To put it into perspective, price tends to react differently depending on the time frame. On higher time frames, such as the 1 hour or 4 hour, price tends to respect order blocks more than fair value gaps. In contrast, on lower time frames, price tends to respect fair value gaps rather than extreme order blocks. Let's assume that price forms a structure like this on a lower time frame, such as the 15-minute or 5-minute chart. In these scenarios, price is often more responsive to fair value gaps that appear above or below order blocks, depending on the trend, frequently reversing from those gaps before reaching the order block. This makes fair value gaps particularly effective for identifying entry opportunities, as they generally provide a higher hit rate compared to extreme order blocks. In a bullish setup, the best practice is to place a buy limit order at the top of the fair value gap with the stop loss placed below the extreme order block. This method often results in a wider stop loss, which in turn reduces the risk-to-reward ratio of the trade. Although it is possible to tighten the stop loss by placing it just below the fair value gap, but it comes with higher risk, as the extreme order block below the gap could still attract price, which will result in your stop loss getting hit. While a tighter stop loss may look attractive, it's important to weigh the risk carefully before applying this strategy. As mentioned earlier, order blocks remain the primary focus for entries on higher timeframes. Even though traders can choose to rely exclusively on order blocks on lower timeframes, doing so may limit their opportunities and cause them to miss several potential trade setups. Now that we have looked at situations where price respects order blocks, fair value gaps, or even both, it is also important to know that there are cases where price doesn't react to either the order blocks or fair value gaps. Think of a scenario where you've identified what seems like the perfect setup. All your strategy's conditions are met, and you've placed a pending order on an order block or fair value gap. But despite everything aligning, price continues in your anticipated direction without reaching your entry, leaving your order unfilled. The main reason behind this kind of price behavior is that price creates a significant inefficiency when attempting to retrace back to the fair value gap or the extreme order block. In such cases, as the price creates a substantial inefficiency on its way towards the extreme order block or fair value gap, it struggles to resist the massive liquidity voids behind it. Therefore, it experiences a pause to fill the liquidity voids caused by the inefficiency. As price retraces and then realigns with its dominant trend, it often fails to move far enough in the opposite direction to trigger pending orders at the extreme order block or fair value gap. This happens because once the market resumes its primary direction, it gains momentum from traders entering on the assumption that the retracement has ended. That surge of orders fuels continuation in the dominant trend, pushing price forward without activating the limit orders placed at those extreme levels. Now let's look at a general trading example that ties together the concepts we've covered so far. Here on the 15-minute euro-dollar chart, we can see that price is in a bullish trend. Following the most recent upward move, we can see that it broke above the previous high, confirming a break of structure. The next step is to identify potential long entries. Here, we have two main options. The traditional approach is to look at the extreme order block, which in this case sits below a fair value gap. Our entry strategy would be as follows. The first option is to place a buy limit order at the highest point of the order block, allowing price to mitigate it before moving higher. While the second option is to place a buy limit order at the top of the fair value gap. This approach is commonly seen in lower timeframes. So since we are trading on lower timeframe, we will be using the second option, which is entering at the fair value gap. Now, when entering at the fair value gap, you could place your entry at the highest point of the fair value gap and set your stop loss just below the fair value gap. While this method can be effective, it's worth noting that the stop loss will be very tight. And since there's still an unmitigated order block at the extreme, there's always a chance that price may dip lower to fill it. If that happens, a tight stop loss could easily get triggered. So to account for this, it's often safer to keep the stop loss slightly wider by placing it below the order block. The purpose of this entry method is to minimize the chances of missing a trade, even though it slightly lowers the reward to risk ratio. So, having placed our entry at the fair value gap and our stop loss below the order block, we then target a 1-to-2 risk to reward ratio. And letting the trade play out, you can see how price tapped into the fair value gap and pushed up to our target, resulting in a profitable trade. And that's how we were able to catch this move by entering at the fair value gap. So if we had placed our entry on the order block, waiting for price to come and mitigate it, we would have missed this trade. So, now that you have learned how to identify best entry points for your trades, you can go and backtest it to see how you can apply it for better results. If you found this video helpful, don't forget to hit the like button, also subscribe and turn on the notification bell to stay informed whenever we make new videos.